We're here to talk about Silicon Valley real estate market on June 28th. How can I be doing that on June 27th? The 28th is my normal weekly reference. I use the same dates and not much activity gets reported on to the MLSs over the weekend. Presenting the data for the 27th, which goes back 35 days from last night at midnight, and comparing it to data that I would get tonight at midnight and going back for 35 days is very similar. And that's why I'm able to do it. I'm just keeping that as the reference point, but today is June 27th. These are the key chapters and approximate timelines and the slide numbers that we're going to be going over. Here's the first data slide. This is showing level of offers accepted. And down here in the light blue, you have 1 week worth of data. And you can see this dated line here went down from last week to this week, which caught me a little by surprise. I wasn't expecting that kind of a decrease. There's a 2 week decrease. 3 weeks has actually got a little bit of an increase. But 4 weeks has a significant decrease. My data is based on 5 weeks for the bulk of the presentation is down. This is a sort of a leading indicator. It's trying to show you what's happening compared to normal. Buyers are more significant than inventory. They're both important. It's the ratio that's really important, but the buyers are more significant because they're the ones that are signing up for a 30-year commitment on those mortgage payments. I'm also right now in the developments of a brand new metric that I think I'll may be able to introduce as early as next week that will be real interesting. But anyway, volume of sales continues to be below where we would expect it to be based on the previous 10 years. And this week, I think we're about 22% down. And here's sort of that recap. We have 19% longer marketing time. That's 45 days, 6.5 weeks. That's still very good compared to most of the country, but it is slow for, well, essentially 20% slower than it normally is for Silicon Valley. Marketing time, and the difference between turnover time and marketing time is turnover time is theoretical, and it does not get impacted by agents and sellers that relist their properties. Marketing time is the time that 3 out of 4 sellers take to sell their property. So relisting would artificially lower the marketing time. But right now, marketing time, and I will personally, professionally believe that relisting is an insignificant percentage of the market share. That seems to be the interest of most of the people that are writing to me. Richard, you're ignoring the relist. The relist, every time I look at it, and I've looked at it twice already this year, is like 2 and 3%. It just doesn't impact the data. 40% longer marketing time, 30 days. So it's taking a month for 3 out of 4 sellers to sell their house. The other thing marketing time doesn't include, that turnover time does, is marketing time does not include the unsuccessful sellers, the sellers that come on the marketplace and give up without ever selling their property because the offer was never accepted. And so therefore you don't have a duration of that time period. Right now we're taking 1 3/4 times longer price reductions, but keep in mind that's only 1.4%. But on the flip side, the reason that number is so small is something like 80% of the sellers do no price adjustments at all. And the 20% that are doing price adjustments, some of those, especially at the upper end, get to be pretty significant. I think we'll see later on that it's probably about 10 times this or about 14% of a price reduction, which when you're talking about a $2 million home is in excess of a $250,000 price reduction. Offer shortage, that's what we talked about already a little bit, 22% shortage. So we're only selling 78% of the property that we're supposed to be. It was only, I said 15%. I think that was supposed to be last week. It was only 15% shortage last week. So there was a 50% increase in the amount of shortage. We went from an 85% of the market you'd expect down to 78% of the market you'd expect in 1 week. Now, if this was next week, I would say that's okay because that's the holiday week. This coming week, I would expect less inventory coming on the marketplace because sellers don't like to come on the marketplace. And yes, July 4th is a week from today, actually. But the holiday is on Friday. And for example, title company I'm working with is closing down at noon on Thursday. So next week is the week that's going to impact the data. So I'd expect significantly fewer new listings this week. I'd expect the buyers to buy this week and then flip it for the week after. That's getting way ahead of ourselves. Inventory is exactly normal. I think it's real close to 100%, 99.7%. You can't really get closer than that. In real estate to normal. So it's 100% normal inventory. So buyers have the normal amount of choice. 7.2%. These group up here were all leading indicators. Lagging indicators require the sale price. Right now, the overbidding is 7.2%. That's almost a 0.5%, 0.4% higher than the normal based on the previous 10 years of 6.8%. So even though the indicators are the market is slower than it normally is, buyers are actually overbidding more than they typically do. Now that could be because sellers are adjusting their price to account for the market. It could just be buyers are getting tired of looking and throwing more money at an offer than they should be just to get out of the rat race. There's all kinds of reasons for it, but overbidding right now, the pressure the buyers are feeling is greater than it typically is. Prices have been increasing and have been going down, especially in San Francisco, Marin, as well as Silicon Valley, Santa Clara, San Mateo, and Alameda counties. Here's the actual graphs. You can see the turnover time has been up here. It's approaching the blue line, which always favors the buyer. So it's more favorable than it normally is. And typical year would be right on the gray line, and favoring the seller would be down at the red line. This vertical line here is the current week, and the data is in purple. The reason I don't have the purple line going over on the right-hand side and only the three colored lines is because I don't have future data. I have future data for the past 10 years because the 10 years I use does not include 2026. So my past 10 years are 2025 back through and including 2016. Those are the 10 years that we'll be showing on the graphs later in the presentation. That's what makes up this 10-year median. So turnover time right now is 45.3 days and 19% slower than normal. So in 45 days, 20% slower turnover time than normal. Marketing time, you can see you're actually above the blue line, and that does happen. Then the blue line and the red line are defined by the 10 or the 90 percentile, depending on which metric is good for that particular group of people. Right now, you can see you have 40% longer marketing times. You're right at that 30 days. 1 month to sell a property is not bad. Most places in the country talk about having 3 to 10 months of inventory being normal. I use days of inventory here in the Bay Area, which is the turnover time at 45, because that's a month and a half. I mean, you go anywhere else in the US that I'm aware of, and you say you only have a month and a half supply of inventory, and they'll go, wow, that's pretty tight. And that's actually loose or slower than normal for Silicon Valley. Price reductions, 1.4% price reductions to almost 80%, 1 3/4 times what we normally are having. But typical is only 0.75%. You're almost at 1.5%. That would be almost a doubling. You're a little shy of that, which is why you're at 178% of normal. Here's the overbidding. You can see the overbidding is just a little bit above, but that is almost 0.5%. It's 0.4%. You can see in a robust year before Memorial Day, which is already in the rearview mirror, that number can be pretty high. I think I've seen it up around 12% or something like that. In fact, right there, 11.6% is where the red line is. And you just like you can go above the blue line, you can go above the red line. And I think we've had 12 and 14%, maybe even 12.8. I think I remember seeing overbidding, which is pretty significant. Now, in any given micro market area that we'll get into later, the overbidding can be quite a bit higher. And I think you'll see that it is. But overbidding is pretty close to normal, a little bit on the aggressive side by 0.4%. Offers accepted, you can see getting very close and see this decrease last week. That's a fairly steep decrease for 1 week. If you look at the smoothness of this particular line, and you went from, I think it was 85% to 78%. So you lost a significant amount of the marketplace. And I'm going back 5 weeks in the rearview mirror, which means last week was significantly worse than 5 weeks prior to that. Inventory is basically dead nuts on the normal, right there at 99.7%. You can't get closer to normal. And a very lagging and almost irrelevant indicator is transactions. And that's just because the industry sort of runs on closed transactions. And that's it running at 81% of the volume that we typically do based on the past 10 years. Here now is looking long-term. So now this is where we go all the way back to 2016 over on the left-hand side. You come up to 2025 here with the green line. And then for 2025 is on the expanded scale as well as 2026. You're looking at 3 key indicators. The purple is the bold one. That's the one we're talking about. That's turnover time. You can see it's like 19% slower than it typically is. That's why it's up in the blue. That's an improvement from where we were 10 weeks ago, but it is still slower than it typically is. And also, if you look back in time, it's slower than we are most of the time, and that's on a percentage of normal basis. Now we're flipping down to the bolded orange line, which is offers accepted. Look at the steep decline from last week. We were up here around 80, it looks like it's closer to 87%. I thought it was 85%. We went from somewhere around 85, 87% down to 78%. We've lost a significant percent in 1 week. And if you look back in time, that's a pretty significant drop for a 1 week drop. And the surprising part is I don't remember anything really happening that would cause that kind of a decrease. And also when you're talking about a decrease of, call it roughly 10% of the marketplace, When you're going over 5-week period of time, that's like a 50% decline in the offers over in just the last weeks. The offers accepted last week have to be about 50% less than the offers that were dropped off 5 weeks ago. And then the third and final one is inventory. You can see you're right on normal. You're at 99.7%. So you're just under that 100% line. You can see that inventory has come down fairly significantly in the last couple of weeks. So inventory is sort of matching offers, and it could be that offers are following inventory. Inventory goes down, there's less new stuff for the buyer to make an offer on. So it could be this drop in inventory that could be triggering this drop in offers. You could argue all day long which came first, the chicken or the egg. So, the two are related. But when you have no inventory to pick from, and working with buyers out there, I can tell you firsthand, it is tough finding a property that works for your particular clients. Here again is the Silicon Valley real estate marketplace. We finished up the last 8 minutes or so on the Greater Bay Area. The purpose of the Greater Bay Area, which is 13 counties and 5 regions, is to give you an idea of whether a trend you're seeing here in Silicon Valley, which is my focus, is more global or more localized. If you want to get a PowerPoint, it is up. You can hit the QR code on the top left over here, or the long blue URL, or I like the short green root URL because I can remember it, and then just H for handout 2026-06-27. It's the date that the Saturday presentation that you put in there. That's why I have it out here for you. If you want to join Saturday morning at 9 o'clock and listen to the presentation live and ask questions, interact with me, I'd appreciate that. Hit the QR code here on the right-hand side in the middle. You can also use the blue Zoom link. Archive is the YouTube channel. And I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley. Here's an example of the kind of added information I can provide for buyers that want to work with me. The school links, the school scores, commute time, the direction the house or the front door or both face. And I think this is something that's not being paid attention to enough, is the fire severity zones. San Jose has put a lot of Alameda Valley and Evergreen, the expensive areas of Evergreen, into high fire zone severity. And I think as the insurance companies, and this change just happened January 1st of 2026 by city council action, I think in about a year or 2 years from now, when that gets widely known, that's going to impact insurance rates in those areas. And it may be more difficult for the homeowners and the buyers to get fire insurance at a reasonable rate in those larger areas of concentrated homes. Here's some definitions of the next stuff that we're going to be going over to. And here is the summary slide. So these are the micro market areas, and you can see that we're definitely getting more blue over here and more green. So that means slow. Blue is actually slow. And when you're talking about a turnover time of 143 days, that is slow. If what is that? That's 5 months. Pleasanton and even Livermore, 170 days. That's almost 6 months to sell the property. That's why those are showing up as blue. The marketing time for 3 out of 4 sellers and the coast is 3 months. That's still, it's not anywhere close to the 5 months or anything like that, but still 3 months for 3 out of 4 sellers. And that means that 1 out of 4 sellers is taking longer than 3 months to sell their property. Price reductions, you can see they're mostly blue in color. That means they're starting to be significant, 2.3%, 2.7%. You have overbidding, which is a lagging indicator, and that's still red. So even though all the fundamentals are blue, the actual buyers making the commitment to write the offers are still overbidding fairly aggressively. In fact, you come down to Berkeley and Alameda, they're overbidding almost 27%. That's more than 1/4% higher, more than 1/4 higher. Whatever the seller's ask price is, on average, they're going in 1/4 higher than that. And that's just amazing. 90% of the sellers get more than they're asking for. In Oakland, 80% of the sellers are getting more than they're asking for. Now, granted, overall, Silicon Valley is only 67 or 2 out of 3 sellers, and that's still aggressive. The dark green is where we're comparing to normal. So here you can see there's very little red. The only area that has red is Foster City, and at 2%, 70% would be red. 102% should not be red, because look, 105% is green, and that's normal. That should be, I don't know what went on. Is that Foster City? My Foster City data has been really weird. I don't know what's going on with that. I need to look into that. I've looked into it. I thought I corrected it. Clearly, I haven't corrected it. But Foster City is such a small area, it's not impacting the data. And it's probably the calculation of the data for that alone. The data looks right. The 102 looks right. The red is, I'm questioning the color assignment for that. And I don't understand because I'm looking up in a table. Magnitude of overbidding and frequency of overbidding, you can see it's basically blue. So Even though they're still high in magnitude, they're lower than they typically are for this time of the year. Here's your offers. You can see that offers accepted are on the low side. Alameda County is at 70% of normal. Overall, Silicon Valley is at almost 80%. Santa Clara County is at 83%. San Mateo County is what I called right on normal at 96%. But again, look at the range. You got 52% on the coast and 47% on the Foster City. That's 2 out of my 6 areas, but they make up a very small number. In fact, come over and look at Foster City is only 9 listings and the coast is only 12. Together, they're 21 listings out of 400. So what's going on in those 2 micromarket areas, even though they're a significant percentage of the lineage on my graph and a significant part of the geographical area, because Half Moon Bay area is so rural, they really are not a significant percentage of the overall marketplace. Looking at active inventory, you can see inventory is fairly close to normal. You got some areas that are a little bit short of inventory. Like look at the expensive areas of Los Altos and Palo Alto in Santa Clara County, only half the inventory you'd expect. In the expensive areas in San Mateo County, half the inventory you'd expect. But when you get into the more affordable areas, South County, you have 12% more. You have 27% more in the coast. Coming down Alameda County, where I don't have micromarket data, overall the county is at 92% of the inventory you'd expect. And then appreciation, Santa Clara County has the highest amount of appreciation. And I think that's because folks were willing to commute a little bit further during the pandemic, causing the prices to go up. And I think we're starting to see a little reversal where areas like Pleasanton did really well and Livermore, they're sort of almost hurting right at the moment because people are getting tired of the longer commute when they have to go more often. And finally, we have the sold price, and the middle number is the median that most people follow. I supplement that with the 10 percentile on the left-hand side. So that's the least priced area home, single family home that you'd expect in that given area. And the right-hand number is 90% or the most expensive. And again, all this data is on single family homes only. I try to weed out condos and townhouses
from my data sets. People ask
occasionally. I don't have turnover time raw data for this week, unfortunately, but compared to normal, Silicon Valley is 20% of normal, which is 20% slower. Silicon Valley is 22% slower. San Mateo County is actually 6% faster than normal at 94%, and Alameda County is at 20% slower, just like Santa Clara County. So Santa Clara and Alameda County are very similar and slower than normal. San Mateo County is quicker than normal. Here is the marketing time. This is the time it takes 3 out of 4 sellers to sell. Silicon Valley overall is 30 days. Santa Clara County is the slowest at 33 days. San Mateo is the fastest at 27. And then Alameda County is in the middle at 30 days. You can see the micromarket data in all 3 counties varies. In Santa Clara County, it's from a fast at 26 days in your expensive areas to a slow at 43 days in Saratoga, Los Gatos, which are sort of close together and both similar in price. So, right now, marketing time doesn't seem to have to do with geographic or with pricing. If you go into San Mateo County, the longest one is the coast, but if you ignore that, the longest one is the expensive areas. The fastest one is your what I call the base cities: Belmont, Burlingame, San Mateo, San Carlos area, those areas. And in Alameda County, your fastest is going to be Fremont at 23 days, and your longest is Pleasanton at 40 days. So each county has a pretty wide range. And if you're trying to buy in one micromarket area or sell in a micromarket area, what the county or your neighboring micromarket area is doing is completely irrelevant to the marketplace that you're experiencing. Here's marketing time versus typical. You can see it's basically green in color to blue in color, which means it's normal to slower than normal. Overall, Silicon Valley is 40% slower than normal. Santa Clara County is the worst off at 53% slower than normal. And look at Cupertino, Sunnyvale, 90% slower than normal. If I went back and looked at, let's go back and look at it. Cupertino, Sunnyvale, still 33 days. So that's a reasonable time and right there with the county median, but that's double the speed that they normally are. So that's normally a fairly fast-paced area. And right now it's not for whatever reason. So, things change frequently in the marketplace, which is something I think that people that are doing monthly data that is coming out at the mid-month to the end of the following month and is focusing on recordings, which most stats are, is completely missing the market on what's happening with marketing time and turnover time and overbidding and those kinds of issues. But that's just my professional opinion. Look at Redwood City, 48% longer than normal. The coast is, again, a small area. But then you come down to Belmont, right next door, 85%, so 15% faster. So you go from two areas that are similarly priced next to each other. One is significantly faster and one significantly slower. Here's reductions of the seller's ask price. Silicon Valley overall is 1.3%. That might not sound like a lot, but that's clearly in the range up here favoring the buyers. Santa Clara County again is in last place at almost 2% of a price reduction. The affordable areas are taking 2.3, Saratoga Las Gatos 2.7. The smallest area looks like Gilroy at just under 1%. This is the magnitude compared to typical. So how is this compared to normal? You can see that you have green, which is normal, and then you have blue, which is greater price reductions than are normally experienced for the corresponding time of the year. This is where I take the same dates, the same week, and compare week to week. Real estate is driven by open houses in Silicon Valley, is driven by open houses on the weekend, and then the offers are accepted during the following week. Very little activity is actually reported over the weekends, even though that's when most of the buyer activity occurs. Here's the reduction of price and frequency compared to the raw counts. So Saratoga Las Gatos, your expensive areas in San Mateo, they're doing fairly significant price reductions. A third of the sellers are doing a price reduction in Saratoga Las Gatos. 50% of the sellers are doing a price reduction on the San Mateo County coast. 40% in the expensive areas. Anything over a third, I'm saturated blue because we rarely get to a third of the sellers that are taking a price reductions. And Pleasanton's up there at a third. So you have several areas that are right up at my maximum, and then a lot of the areas are more around 20%. You have some that are down in single digits, like Belmont, at 8%. Again, a big difference here: 8%, or call it 9% in Belmont, 19% in Redwood City. A huge difference in the frequency. Here's that frequency compared to normal. So you can see it's mostly, I would say it's mostly blue or green in color. There's a few red areas. Again, Foster City is goofed up. And with 9 homes, I may need to just drop Foster City out because it's very possible that it's just statistical fluctuation, but that one color coding was clearly wrong earlier in the presentation. So frequency, I would say favoring the buyer, so more frequent price reductions than typical. Here's overbidding. So with all that pessimistic news that I've already presented, you would think there'd be less overbidding. No, there's more overbidding. In fact, you can see it's red, so it's pretty aggressive. It's not huge numbers, 7%, 10% down there in Pacifica, 8% in Belmont, 19%. These are the aggressive ones, 19% in Oakland and 27% in Berkeley and Alameda. And that's been consistent for a long time. I have no idea how long. I would say probably a year or maybe even longer. And it may be that they're more affordable and closer into workplaces. They're just on fire. And I don't understand how you have that kind of overbidding long term. You think if you have long-term overbidding, the sellers would simply move their price up and you would cut down the amount of overbidding. Here's overbidding versus typical. And look at the same two down here at the bottom. It's only 5% more overbidding than it typically is for Oakland, and it's 7% more than Berkeley and Alameda. Everybody else almost is under 100%. You got Los Altos at 102% and Gilroy at 100. But most people are doing less overbidding than normal. The two stickouts again are on pricing on overbidding are Oakland, Berkeley, and Alameda. And that's the island of Alameda, the city of Alameda. Here's overbidding frequency from the buyer. Well, happening all the time. Almost 2/3, just under 2/3 of the buyers in Silicon Valley are paying more than the seller's ask. Now, Morgan Hill, that was doing okay, really has less, and overbidding really doesn't seem to happen down there. They're at under 50% of the sellers get more than their asking price. But you go anywhere else, and 50% is pretty amazing. And it's frankly almost freaky that when 1 out of 5 sellers is getting more than their asking price, that's a cool buyer's marketplace. I mean, you would think an expensive item like a house, in the 80s and even early 90s, prices were negotiated down, not negotiated up. Overbid frequency, how common is the overbidding? And this is compared to normal. So you can see most of these areas are under 100%. In fact, the only areas I'm seeing over 100% are Berkeley and Alameda at 106%, Redwood City at essentially 110%, Los Altos, Palo Alto at 111%. Everybody else is at or below 100% that I'm picking up. So clearly overbidding frequency, even though it's still frequent, is less frequent than it typically is. And that's based on the 10 years. Here's offers accepted. Here you're across the board, either blue, and the vast majority of the areas are blue, which are favoring the buyer, which means you're more than 12.5% of the marketplace is missing, or they're green, which is basically in the normal, which is within 12% of normal. But there isn't a single area that's over. There's my single area, Cupertino Sunnyvale, at 6% more inventory, more offers accepted than normal. So even though they're having longer marketing time, I think it was, they're having more offers accepted. Here's active inventory. So this is what buyers have available. There's a shortage up here right along the Clara, San Mateo County coast. Everybody else is normal. The other exception would be Saratoga, Las Gatos, at 72% of the marketplace. Almost every other area that I'm seeing, Belmont is at 82%, and Alameda County overall is missing 8%. Here's the appreciation. So the red areas are the areas where the greater appreciations happen, and this is going all the way back through to the last 9 months of 2015. So it's a long-term or a longer-term appreciation. Here's my pricing. The middle number is the median. The left-hand number is the lower price. The right-hand number is the higher price. Color is assigned by the median price. Here's the summary chart that we went over at the beginning. Here's some definitions that we're going to be getting into. And now we're going back to that 2016 timeframe on the far left-hand side. You're going up. This is the turnover time. Look how sharply this turnover time went up this last week. Yes, it does change quickly, but now you've had several weeks in a row of increasing. This decrease was the Memorial Day holiday, so that you sort of ignore. So you went straight across, and basically the real news is this last week increase. This is turnover time versus typical, so you can see it reversed and went up, so you can see how it typically fluctuates. So it's been basically flat, but this last week is sort of it was unexpected and surprising in magnitude. Here's the marketing time. You can see it's climbing. We're now up to that 30 days. Just a few weeks ago, we were at 21, 22 days. So you've climbed up quite a bit in just the last couple of weeks. Here's the time for the typical sellers to sell. Now that actually improved this last week. So that's on the positive side. You dropped from almost 48% slower than normal to 40% slower than normal. Here's the number I like. This is the biggest 2.5%. The largest price reductions. How big are they? They're 13.5%, right on the blue line. So large amounts of price reductions, large magnitude of price reductions. Here's the more normal number. So this is the average number that almost everybody else would quote, and that's probably about 1.38% of a price reduction. So we'll call it a 1.4% price reduction. Let's round numbers up. So compared to normal, where are we going? We're larger price reductions normal, which is why you're in the shade of blue. We've been having larger shades of price reductions basically ever since the 2022 price correction. Yes, 2024 was basically in normal level, but overall, since 2022, we've been taking larger price reductions than typical. Here's the frequency of those price reductions. You can see the frequency is climbing up and will probably continue to climb up based on past history. That's the value of having the lines here. Real estate's very cyclical. Normally if you had a constant market year round, these lines would be horizontal, which is why I'm drawing them in, is you have to compare to what's happening typically for this time of the year. Here's the frequency compared to normal. So now you're about 30% more frequent price reductions than typical. Here's overbidding. So you're below and this is the one graph that I have the median on. So this is the midpoint. So the midpoint normally is up here at something like 4.5% overbidding. The midpoint is at 3%. So the midpoint is actually less overbidding. But if you flip over and look at the average overbidding is 0.4% above. So it's more buyers are going a little bit over, but there are still a significant number of sellers that are buyers that are going way over the seller's ask price. Here's the frequency of that. So you're less frequent than normal, but you still have almost 2/3 of your sellers getting more than they're asking full price. Here's the frequency. It's 92% of where it typically is. So less frequent than typical, but still a lot of overbidding. Here's offers accepted. Here again, see that decrease in offers accepted? We went from 2,300 down to 2,100. We lost almost 10% of the marketplace in 1 week. That's significant, especially when I'm not sure what would have caused it. One thing that could cause it is simply, for some reason, late reporting. If real estate agents sold their houses on Thursday and Friday and took off out of town for the 4th of July week before reporting the sale, that would explain the drop, but that's not the market condition. So I have no idea, and I'd be real curious to see if that improves over the next week and if that decrease minimizes at all. Here's active inventory. We went from a little bit of a surplus because you're above the gray line to right on the normal level. I would expect less listings next week, this coming week, because of the 4th of July weekend. And then, so I would expect this gray pattern to follow. Now, it will be interesting to see if we actually cross over the gray line and get into a shortage of inventory. That really hasn't happened yet, and hasn't happened for any significant period of time except way back here in 2023 when there was a shortage of active inventory. Here's some pricing models that I have. The most expensive up here clearly shows a rate of increase and then a continued increase, but at a much slower rate. The median price is increasing slightly, but not as steep as the high end. And the lowest priced homes are actually decreasing in value. Now, this doesn't necessarily mean decreasing in value, as I said, but decrease the bottom. There could be more sales at the low end of the marketplace, but clearly the upper end of the marketplace is doing better than the low end of the marketplace. Here's some definitions as we go and compare the three counties to each other. Here in the gray is Alameda County, showing turnover time as being the slowest out of the three at 52 days. Then you have the Santa Clara County in the blue at 44 days, and the fastest county down here in the orange at 35 days. So turnover time is still reasonable for all three counties, with San Mateo County being the fastest and Alameda County being the slowest. Time to sell, closer together, but different order. Santa Clara County is the slowest at 33 days. Alameda County is next at 30 days. And similarly, San Mateo County is the fastest again at 27 days for 3 out of 4 sellers to sell. Price reductions, Santa Clara County by far taking the most price reductions, approaching 2%, but right now at 1 3/4% price reductions. So Alameda County in the gray and San Mateo in the orange, just over 1%, probably 1.1% for San Mateo County and probably 1.2% for Alameda County. Here is the frequency of price reductions. Again, Santa Clara County by far the largest amount of price reductions at 25%. That's 1 out of 4 sellers are doing price reductions. And if you go back over time and just look at the blue line, not very often has more frequent sellers have been doing price reductions than currently in Santa Clara County. Then you have San Mateo County in the orange and Alameda County in the gray, very close together. San Mateo County is probably 17%, and Alameda County is probably at about 15.5% for the sellers taking price reduction. Moving on to average overbid, Alameda County by far has the most overbid and has had for all of second quarter at around 11% average overbid. That's huge. San Mateo County is next at about 6.5% overbidding, and third and last place is Santa Clara County at somewhere just under 4%, about 3.8% overbid on average. Frequency of the price reductions, Santa Clara County is the least frequent at about 62%. San Mateo County next at about 67% or 2/3, and Alameda County at almost 70% of the sellers are getting more than their overbidding. You can see that we've never really been below 30%, and we've really never been above 90%. So it's tough to get that last 10% of the sellers to get overbids, and it's tough to not have at least a third of the sellers getting overbid. So we're in a very narrow band from basically 30% to 90%. We're only operating in a 60% range. Offers accepted, and this is not looking at pending data as a lot of people talk about. And the reason I look at offers accepted is each transaction, whether it lasts 1 day in the escrow or 10 weeks in escrow, counts the same weight as offers. If you're looking at pending data, transactions that stay around for a long time, they impact the data for longer. Now, I noticed that somebody started a new word called pended data, which I think is very similar to my offers accepted, but they really don't do a good definition of it. I think the difference between their pended data and my offer data is their pended data appears to count an offer that was initiated even if it subsequently failed, where I continually update the data for 13 weeks after the current data. So this week's data will be updated 13 more times before I then call it fixed. Even then, I go back and at the end of each calendar year, I update the whole previous year and the year before to try to improve the data integrity. Because weekly I do increments, and if one listing got added in twice, well, added in twice I would catch, but if a listing got dropped on one of my incremental ads, I can catch it with my yearly update. But the numbers of those are very small. In fact, I try to figure out a way to track of how many I have for my cumulative data and how many I end up with my end of the year data and see what the error rate is, but only so much I can do. Anyway, offers accepted. You can see they're down in all 3 counties. The smallest county is San Mateo County, and they're at about 450 transactions. Alameda County next at about 800 transactions, and Santa Clara County has the most at about 875 transactions accepted in the last 5 weeks. It has not failed escrow. Here's the active inventory. Alameda County has the most inventory now at almost 1,200. Santa Clara County is next at just over 1,100, and the smallest county is San Mateo at 450. But San Mateo County is at 450, the closest to 450 on the offer, so they have the fastest turnover. Alameda County is at 800 versus an inventory of almost 1,200, and then Santa Clara County is at 1,100 and 800. So San Mateo County has the fastest turnover time. Here's the appreciation. Santa Clara County has the highest appreciation at about 105%. San Mateo County is next at about 95%, and the least amount of appreciation is Alameda County at 80% appreciation. Here's the median sold price, same order, I think. San Mateo County has the highest price at just over 2,200,000. Santa Clara County is next at just under 2 million, and the most affordable county is Alameda County at about 1,330,000 roughly. Here's the same exact information on log paper. This is so you can see the rate of appreciation easier or depreciation. This is your payment. This assumes an 80% loan using the high balance conforming loan rate, which is not a very good metric, but it gives you a global idea of what's happening to payments relative to pricing. You can see there was a huge increase in cost of home ownership here, and that would have been divided up between the cost of interest rates and also the increasing price. I will maintain that prices of homes are less dependent on interest rate than most people think, because a significant percentage of your payment, 1.25% roughly, stays fixed with your property tax insurance and has no bearing on interest rates. Your insurance is increasing and becoming significant for some property owners and remains fixed with interest rates. And with interest rates themselves, if your interest rates go from 3% to 6%, that's a doubling of your interest rate. Your payment doesn't double because your allocation of the payment shifts between principal to less going towards principal as the interest rates go up. The more higher the interest rates, the less you pay towards principal in those first years. Here's the real note taking thing. You went from 6th out of 10th place in the last week to 9th out of 10 place. So you went down significantly. More shockingly, you went from 21st position to 24th position in 1 week, unexpectedly, after we had been improving. We were 24th and 9th earlier this year in January timeframe, but we had improved and we're pretty much 21, 22% year all along. And now here we have a jump down to 24%. I was not expecting this. You can see that your 2119, this number will decrease. It will not go below the 1988 that we had in 2023. Here is the data for Silicon Valley, Santa Clara County, San Mateo, or Alameda County. The metrics are coming down the left-hand side. There are 2 different appreciations on here, one since 2015, one since just 2020, basically since the pandemic. You can see that Santa Clara County has outperformed, followed by San Mateo County. Alameda County has underperformed since the pandemic. Here's some definitions for the metrics that we're going over. We're going over 3 key distributions. The distributions are marketing time, price reductions, and overbidding. So here's marketing time. The concept on all 3 is the same. The purple line is the current week data. The dotted line, the gray dotted line that's bold larger behind it and below it up here on the right-hand side above over here is where we were last year. Marketing time is essentially exactly where we were last year. Down here, we're marketing a little bit faster this year. On the longer ones, we're taking a little bit longer. Let's step through and see what happens. The key takeaway is the first couple weeks. Which direction do you expect the market to go in the near future? I think what happened last year is a pretty good indicator of what to expect this year, because we're such a cyclical marketplace. And one question I have, would you, instead of doing this for a 1-year comparison, would you like me to change and do my comparison this current year to where the 10-year median normally is? So in other words, take my 2016 through 2025 data, come up with a marketing time median and plot that, and then show where the purple line is expected to go based on the past 10 years instead of just based on 1 year. And the reason I'm thinking that may be significant is there could be a change in the marketplace where last year's data becomes pretty irrelevant to the current year's data, but the 10-year trend is probably going to always be somewhat relevant. And that was my thought process. Appreciate any feedback people have, but anyway, now we're just comparing the last 52 weeks. So the dotted line, which is what we're starting off on, is 52 weeks ago. Let's see, it increased dramatically, another dramatic increase, and they're not dramatic. Now you're sort of hitting a plateau where the increases are smaller, now very flat. So that would indicate I expect marketing times to increase basically now through the middle of September. Then in October, I expect them to improve. That's getting pretty far out there, but then at the end of Halloween, or at Halloween, I'd expect them to deteriorate into the end of the year. And right there is probably, okay, right there on January the 3rd is probably the worst year. Now on January 17th, it's already improved. Notice how steep this is getting over on the right-hand side. That's improving when it gets steep like that. And as soon as it shallows out, you know the market's already slowing down. And you can see the first of the year, you start getting more longer and longer marketing times. So if a person wanted to minimize their marketing time, they'd want to go on the market right after the first of the year. Not saying that that's the wise move, because there's other consideration like pricing, activity, overbidding, and all those kinds of things. And you can see that the purple line, the current week, is just above the dotted line of a year ago up here on the top. And down over here, the dotted line is peaking its head above the purple line. So I would say that we're completely similar to where we were last year. Same concept on largest price reductions. And when I say largest, we're going from the 97.5 percentile down to the 82.5 percentile. So I'm looking at 15% of the marketplace only, downshifted by 2.5%. I am considering expanding this a little bit here, potentially up to about 25%, so people can see the trend a little bit more, because now that we're down and we're having somewhere around 22% or something, 25% of the sellers do price reductions, it might be more interesting. When you're up here and everybody's at the straight line, it focuses all the concentration down here, which is why I expanded it, but I think I may have cut it off too short. And if you have any feedback on whether you want that, what percentage you'd like to see it, 100% makes no sense at all, because the highest percent we really have of any magnitude is a 33%, and that's so short-lived. I think that would be too high. So probably the benchmarks would be like 25% or 30% would be probably the two logical choices to pick for looking at the largest price reductions. Anyway, concept's the same. We're on the purple line. We're starting off on the dotted line, which is in the background here. You can see over here at the high end, you're taking a little bit more price reductions this year. On the low end, you're taking a little bit less price reductions than we did a year ago. What direction though is it going? It's going down. So you'd expect more and more price reductions for the month of July, and then finally in the month of August, you'd expect a plateau. And then finally, in some time coming up, maybe in October, there it is, an improvement in the end of September, October, and then Halloween, you're already decreasing again. So largest price reduction seems to precede the days on market by about 1 week. And it's a one increment, which is a 2-week period of time. There's the peak coming up right there on March the 1st. Now you're already improving a little bit, and now you're improving dramatically week after week. And this is every 2 weeks still. Only the last 5 weeks. Starting now, you're 1 week at a time. So you can see how price reductions are getting larger and larger every single week, and we expect that trend to continue. Moving on to the third and final distribution, which is overbidding. This is what the buyers are doing. The overbidding this year is significantly higher than last year. Remember, the dotted line is last year. You have significantly overbidding all the way across the board. So even though the market's probably very similar to last year, buyers are overbidding more this year than they did last year. We're starting off on the dotted line. Which way do we go? We're going down. So even on overbidding that's lagging, we expect less and less overbidding going forward. Keep in mind, this is a lagging indicator by the duration of escrow, but there's your improvement for the month of September. It's continuing to improve. Now Halloween, now into November, Thanksgiving, and we finally have the decrease. There's the bottom on January 31st. There's sort of the peak on April 12th. And it would have been 5 weeks earlier than that, which puts it back around March the 12th. And there we are again in the current week. So you can see that we're doing significantly more overbidding across the board this year than we did just last year. Now we're going to move over to the final section, which is the Greater Bay Area, 13 counties and 5 regions. These are the regions and the counties. Some definitions. This is turnover time. This is how long does it theoretically take. You can see it's increasing in Silicon Valley. The cities is decreasing. So there's 2 regions that are going in opposite directions. North Bay and Central Valley are basically flat, and Santa Cruz, Monterey is just bouncing around the Central Coast. Turnover time to sell. How long is it taking the successful seller to sell? 3 out of 4 sellers. All 5 regions, I would say, are increasing, even though it's noteworthy. You had a decrease in Central Valley, a decrease in the Central Coast, and a decrease in the North Bay. The reason I think that I said initially all of them were increasing is I think the more global trend is up. Silicon Valley and the cities are clearly on an upward trajectory. I'm suspecting these are just fluctuations, and after another 2 or 3 weeks. And that's one reason I also like doing weekly data, because I believe it takes 3 data points in order to set a trend. So if you're looking at monthly data, you don't see the trend change for 3 months, where if you're looking at weekly data, you see the trend change in 3 weeks. Here's price reductions. You can see that they're all increasing amount of decreases, so larger and larger or more frequent price reductions. The one exception is Santa Cruz, Monterey, Central Coast down here in the blue. It's a smaller area, so it bounces more. You can see that there's a lot more instability. So I can't, I wouldn't put much weight in this. There's very good probability that this will go down just next week, and we'll just have a little zigzag in the graph. I would focus on these up here. They're clearly larger, especially these 3. The cities is the other smaller region. And the Silicon Valley, the Central Valley, and the North Bay are very large regions, and they're all on the downward trajectory. Here, I would say they're all on the upward trajectory. You got a little fluctuation again on the Central Coast, and this is the frequency of price reductions. So anywhere from a low in the cities of 16% of the sellers getting price reductions, all the way up to the Central Valley, where 32%, so a doubling of the low cities are doing price reductions. And that's the price reductions the seller takes before the offer comes in the door. Here's the overbid. Look at the cities up here at 16% overbidding. Next is Silicon Valley at 7%. North Bay is at 1.75%. Central Valley is right at 100%, and Central Coast is at 1% price reduction at the time the offer is accepted. I would say that the overbidding is basically flat, so not going in either direction for all 5 regions. Frequency of overbidding, so this is just how common is it, roughly flat, maybe a slightly downward trend. The one exception for a downward trend would clearly be the cities, which would be on a slightly upward trajectory. But the cities is the high benchmark at about 76%. Then you have Silicon Valley at about 66%. Then you have the North Bay at about 45% of the sellers getting more than their asking price. Central Valley at about 39%. And finally, the Central Coast having the least overbidding at about 33%, or 1 out of 3 sellers getting more than their asking price. And you can see the blue line is traditionally at the bottom of the pack, getting the least amount of overbidding. Offers accepted. Here's where we have a mixed signal. You clearly have Silicon Valley coming down dramatically last week, where everybody else is flat. You might say that the cities rolled over and went down slightly, and even the Central Coast, but they're so small, I would still call those flat. Here, Silicon Valley is really bucking the trend and in a downward trend, and it's significant. I mean, you're talking about losing 200 transactions in 1 week when you're using a 5-week average. Just look back over time. And granted, this is going to be shallower. Once you go on this steeper climb, this decline here is going to be twice as steep as it currently is, and it's pretty close to vertical. There really isn't any other time other than the end of the year where we've seen this kind of decrease, this magnitude. Even here, you go from here to here, that is not as big of a decrease as from here to here, and they were both done in 1 week. So I'm a little puzzled on why Silicon Valley appears to have had such a large decrease in the number of offers accepted. Here's the active inventory. You have mostly increasing inventory in the North Bay, Central Valley, and Central Coast, flat to decreasing in the Silicon Valley, and definitely more decreasing in the cities. So the closer in areas are potentially decreasing inventory, where the other 3 regions are increasing inventory. Here's the appreciation. Silicon Valley and Central Valley have basically tied for the highest appreciation at just under 100%. Then you have the Central Coast at about 86% appreciation. North Bay at about 74% appreciation. And finally, in last place is the cities at about 61% price appreciation. And that's since the last 9 months of 2015. Here's the sold price for the 5 regions. You can see that the most expensive areas, the cities, it's come down fairly significantly in the last week and is now again below their price peak in 2022. Silicon Valley actually went up a little bit this last week and is very close to their 2022 peak. Central Coast is very close, but below their 2022 peak. And same with North Bay and also Central Valley. So all 5 regions are once again below their 2022 peak, even though the prices have been increasing. And that's because of the 2022 price correction that we went through. Here's estimated payments. They're going to be in the exact same order. I'm assuming 80% loan using a high balance conforming. You can get lower interest rates by just going with jumbo most of the time. You also can get lower interest rates if you have stock portfolio relationship pricing. Here's the numbers for the 5 regions. There's a little different presentation. The metrics are across the top on the columns. The now column is the current week's value. The change from 1 week ago is here in the 1 week column, and the 5 week column is the change from 5 weeks ago. Here's my fiscal real estate calendar year. I start off basically on March 1st, and that's because leap year and there's 1 extra day, so I combine the two. And then I jump forward 7 days at a time, come all the way around to February 21st. And then on a regular year, I jump forward 8 days to March 1st or 9 days to March 1st. And that way you're always comparing the same dates. That's why we have June 28th on the slide presentation, because that's my normal benchmark. When it's a weekend day, I feel comfortable doing that. Once we get past Monday data, because Saturday, Sunday, Monday, not a lot of activity gets reported, then I feel uncomfortable doing the comparison because it could be off enough. So in a couple more years, I'll be reverting and doing an early week and a late week. Right now, I'm getting by with just doing the same week. Anyway, that's then my data acquisition. Here's the summary slide. We have been talking about Silicon Valley real estate marketplace. We finished up just minutes ago on the Greater Bay Area, 13 counties and 5 regions. If you want a 75-page PDF of the handout, you can hit the QR code on the top left over here, or hit the green root URL, adding in the letter H for handout 2026-06-27, Saturday's date, or the longer blue URL here will all take you to the same data. No matter how you get there, it's the same information. Same for Saturday morning. If you want to join Saturday morning 9, hit the QR code or any of the other 2 options. If you want to look at an old archive, you hit any of the 3 options down here on the bottom, QR code on the lower left. I'm Richard Calhoun, real estate broker working with buyers or sellers here in Silicon Valley. Looking forward to talking to you about your real estate needs. Take care. Bye for now.